But yeah, today we're here to talk about mid-year market outlook and a risk refresh. Kind of think of today as a temperature check for where things stand. And before I get into any of the, analytics, data, strategies, any of that, I just want to be very clear. You may have questions. I'm not going to have time to address questions today, but what I want you to do is write down all your questions, and you're going to take all those to Scott, okay? Yeah, every question to Scott, and then he'll help you out. But in all reality, I did kind of go over this morning, so I'll try to be aware of time, but you may see me check my watch later and be like, oh shoot, I gotta go through this real quick. So with that being said, we'll get started off, and a couple of ground rules before we get started. One, I just wanted to start with this quote. I just think it's a great quote, for thinking about a mid-year check-in. Successful investing isn't about predicting the future, it's about preparing for it. So what this isn't, and I'll get into some ground rules here, but we're not here to say what the second half is going to bring. That's impossible for us to know, but it's really more about preparation and making sure we're prepared, whether it's good, bad, or indifferent. So as we get in, I want to start with this, and this is just a food for thought, a little exercise for you, but if you think about the next 6 months, and let's say the next 6 months are better than you even expected, are you in a position to benefit from that? In other words, are you going to be able to take advantage of a better than expected market condition? And that's one question you want to answer for yourself. And you say, yeah, markets keep going up. I'm going to be in a great position for that. But even just as important, if not more important, if the next 6 months are worse than expected, are you going to be able to be disciplined and stick to your plan? And this is where, the strategies and plans you've made up until this point will dictate how that looks. Have you done anything to mitigate or minimize damage if we go through a tough period of time in the stock market? And there's a lot of ways to do that. If you're not sure, and you work with us especially, ask us what we've done or what we can do. But you should be able to answer that question. Am I going to be able to stick to my plan if things don't go better than expected or as good as I expected? And the reality is, in any 6-month period, either one of these could come true. It's very difficult to predict the next 6 months at any stage in time. Like I said, the goal of investing is not to predict, it's just to be prepared. What have we done in preparation for this? All right, so ground rules, like I said, today it's not about, you turn on CNBC or Fox and, business, and you hear all these talking heads trying to predict what's going to happen next. The analysts, and they're saying this is going to happen, that's going to happen, we're going to crash, we're going to boom, the reality is most of the time they're wrong, And so this isn't really about us trying to predict, but there are some indicators we can look at, and we will. We're going to look at the market, we're going to look at the economy to try to gauge where things stand, but this isn't really about predictions, and it's not about polarizing discussions about politics or anything like that. We're not here to sell you anything. It's just a mid-year check-in. So plain English review. We're going to talk about some of the, like I said, the indicators, touch on risk management. And one of the themes that you're going to see here is controlling what we can control. There are a lot of external factors we can't control. We don't get to choose when the stock market's good or what happens with tax rates or anything like that, but we can control our plan and how we manage that. So, being prepared for the future. This is just an agenda for this session here. We're going to start with the stock market and take a look at what's happened in the first half of the year. And then we're going to touch on the economy, and we'll talk about why that's also an important indicator for the rest of the year and after that. We'll talk about current events, why those matter and how those could maybe affect anything with your plan. And then we're going to touch on risk, part of the risk refresh. We do feel like a mid-year review is a great time just to check in on where you are with risk and make sure it's still appropriate for you. And then we'll leave with some best practices, maybe some things that you can do to take out of here today to go look at your own situation. All right? So one of the other themes you'll see throughout is, not letting a short-term headline affect or, derail your long-term plan. And sometimes that's hard. There's more headlines than ever. There's times where, you go to bed on a Friday thinking everything's good, and then by Monday you're like, the sky is falling, the news outlets are saying this and that, and Iran and oil, and then the next week it's better, and then it's not better again, so it can be very polarizing. So we'll talk about how to manage through that. Quick exercise before we jump into the markets. I want to just look at a few topics here, and right now I'll just read them, but then I'll kind of ask you guys to give me some insight. But which one of these feels most important right now? If we were to look at protecting what you have, staying invested for growth, understanding the Fed and inflation, knowing when to rebalance, and ignoring the political noise. Let me just have a show of hands here. How many of you would say the most important thing right now is protecting what you have? A couple people? Okay. What about staying invested for growth? Okay, a few people say that. What about understanding the Fed and inflation? Yeah, good luck understanding the Fed, yeah. What about knowing when to rebalance? That's on a couple people's mind, okay. And then what about ignoring the political noise? Yeah, a few people. So it's interesting, I did this exercise this morning as well. These are just different things that are all important, but ask what's most important. And pretty much the same thing that happened here happened this morning. Everyone has different degrees of what's important to them. Some people it's protect, some people it's continue to grow, some people it's understand what's going on in the economy. They're all different. So the point is, we're not all necessarily even trying to achieve the same thing or understand the same thing, but these are all important to all of us. It's just how do we prioritize them? So as we go through today, keep in mind that, I'm going to be general somewhat in what's going on, but there may be certain areas that are more important to you than other areas, and that's okay. All right, let's start with the market. So this is going to be the first section here, and we're going to talk about where the markets stand after the first half. This is just a very high-level look at what's happened in some of the larger sectors, but stocks year-to-date are up. Now, sometimes when people think about the stock market this year, it can be hard to remember that we're 7 months into the year. You really only remember the last month or two, because there's been some pain, and this year there's been some pain. Market started off real strong for the year, and then we went into this, geopolitical event where oil is spiking and the stock market gave a lot back, and it dropped 6-7% pretty quickly, and then it's kind of come back. But if we zoom out, the stock market's on the whole positive for the year, so that's a good indicator that stocks are still doing what we want them to do. Bonds are more attractive than they've been in the last couple of decades still. So bond yields are highly driven by the interest rate environment. Well, we know a couple of years ago that changed dramatically, almost overnight, right? Interest rates kind of went through the roof, and it somewhat revived bonds because all of a sudden a bond felt a little more meaningful than it did for the last 20 years. Still maybe not the most attractive to a lot of investors, but there's maybe a place for bonds in some people's portfolio, but highly interest rate sensitive. Inflation has actually been trending down. It's been cooling, but we're still not where we want to be with inflation. I'll go over the latest inflation numbers today. Corporate earnings are exceeding expectations. In fact, the expectations for corporate earnings are just dramatically high right now. And we'll talk about what that means, because have you ever had a stock that you own and it comes out with an earnings report and the earnings report was really good and then the stock price went down? And you're like, what the heck? It was good news. So we'll talk about why that happens and especially what's going on right now with corporate earnings. Headlines, no shortage. We know that headlines, are every day. It's literally pushed to your phone. Even if you don't want it to, you get a little, oh, nope, there we go again with Iran. So everything's instantaneous now, and it can be hard to ignore some of these headlines. And where people generally get hurt is when they want to react to every headline. I should make a change because I just got that news, or now that I know that, I want to do something differently. Or sometimes it's, oh, I've heard this is a great opportunity. My friend down the road told me this was going to be a hot pick. I got to go buy it. So we'll talk about how to manage some of that. And then lastly, behavior. And behavior is, something that we can control. A lot of times what we find is when the stock market's up and it keeps going up, people's confidence increases at that point. In other words, you almost lean in and you're like, I feel great about the market because it's been going up. And you have to be cautious there too. And we know the market generally goes up, but not always. But confidence usually spikes after things have been good. So it's also not getting complacent and also not letting your plan run away from you. Staying the course and not trying to chase after something just because it's done well, let's say for the last 6 months. So we'll touch on that. All right. Here's a little data on the first half of the year. So I know it doesn't always feel this way, but if we go back to January, the markets are up right around 10%, 10 to 12% across the board with the Dow, S&P, and NASDAQ. Now, that doesn't mean there wasn't some pain in between there, but on the whole, it's still up. The big outlier so far for this year has actually been the Russell 2000. Now, the Russell is small cap or smaller companies, and generally the Russell has lagged over the last handful of years, but this year it's done really well. It's outperformed its peers in the market. And usually the Russell is somewhat more of a leading indicator, because if you think about it, when things start to, let's say the economy starts to tighten and people start pulling the belt back, it's usually the small companies that feel it the most first. It's not necessarily your Amazons of the world and the big, huge, super capitalized companies. It's the smaller guys feel it first, right? So the small companies are actually doing very, very well going into the year, but they also sometimes are more volatile than the larger companies. So we see that move, in both directions a little faster than large cap, generally speaking. But good year so far, and like I said, it's good to not lose sight of what that means for risk moving forward. All right, as far as what drove performance, earnings optimists, investors like what they see, is basically what that comes down to. Investors are willing to pay more for companies that are showing earnings, that are beating earnings, that are doing well, that are profitable, and that's really helped lift up the market. As far as themes go, the main theme lifting the market in the last year or so has been AI. I mean, AI is, everyone knows AI now. Everyone's got some level of investment in AI if you're in the stock market. Whether you know it or not, you do. And let me ask you this. How many of you in the room have used ChatGPT? Okay, about half of you. How many have used any AI software? Okay, so half of you really haven't. So that's interesting. It's a little different than this morning. This morning, pretty much everyone was familiar with it. But ChatGPT is probably the most commercially used just among the public. But there's a lot of different AI being used right now. And if you've used it, I think it's a little easier to see the potential of where it could go, on just how intelligent this is becoming. And a lot of that's even in the last 12 months has rapidly advanced. There's still a lot of speculation, and I'm going to touch more on AI in a bit, but that's been a major theme that's driven growth in the market more recently. Like I said, small caps rebounded sharply. They've been lagging. They've had a really good start to the year. And then with rates, we still see every time any report comes out, including yesterday, we see a market reaction. The market reacts to the rate environment as well. So I'll spend some time on that. All right. Let's go on to 10 here. So this is something I want you to keep in mind just as things move forward. A market theme can move from an obvious opportunity to a crowded trade very quickly. And we've seen this happen a lot in the last year as well. This is kind of the cadence of how this happens. Everyone gets excited about something. It's a stock or a theme. It could be AI related. And then you see the market kind of crowd into that, either into that company or into that sector. And then we see some sharp volatility where it starts to be a little bit of a roller coaster ride. And a lot of times what happens is it ends with a rotation. People are going to rotate onto the next thing. It has a period of time. So one of those, it could be something like memory. I mean, memory has been it's been a crowded space. All of a sudden, everyone's dumping everything into memory. And now we've seen some of these companies pull back 20, 30%, and it's become more volatile. And it might come right back up. But it's a volatile space to be in right now because it became so crowded. And eventually we see rotation. We're actually currently seeing a rotation back into some of the Dow stocks, really, like more of the blue chip stocks are starting to get some of it back. That's why the Dow's kept up with the NASDAQ and the S&P. There's some rotation going on out of some of the more speculative sectors back into the tried and true as, blue chips that people are used to. So all this to say, what you don't see on here is you don't say a sector that says, bad investment. We're not saying that, just because something got overcrowded and volatile and people rotated, that it was necessarily a bad investment, but there can be good companies or good investments that are not priced properly. So you end up overpaying. Example I used this morning, this is more for the ladies out there, but like, let's say you go to Dillard's and you get this just beautiful dress that, you paid for it, but you were like, this thing's worth it. And then you go back a couple weeks later and you're like, that dress is half off now. I could have gotten that for 50% off, but I paid full price. I don't feel like it was as good of a value anymore. Well, that can happen with stocks. All of a sudden, a couple weeks later, you're like, people are buying it now for half of what I paid for it. So even though it could be a good company and a good opportunity, you could still get a bad price. You got to be careful with stocks and with chasing and making decisions like that. Diversification is usually most boring right before it becomes most valuable. It can be kind of boring to be diversified because you see these, stocks or sectors running and you're like, why don't I have everything in that stock? And then 6 months later you say, okay, that's why I didn't have everything in there. I was diversified. So sometimes your portfolio can feel a little boring, and that's okay. That's a common trait of a highly diversified portfolio. It's not always going to be exciting, pedal to the metal, but it's going to be more of a steady ride along the way. All right, let's see. Okay, that's a little bit on the market. Let's get into the economy and what the economy is telling us. So with this one here, I like to use an analogy. The economy is not going to necessarily tell us what the market's going to do next, but think of it like you're driving a car down the road and you're looking out your windshield. You can't see what's around that next corner, but the fact that you're looking out the windshield, you kind of have an idea of what you need to do next. And that's the economy. So it's not going to tell you what's around the corner, but it's just going to give you a little more visibility on what's going on, big picture. And it kind of helps you be a little more intelligent with your decision making. Imagine not being able to see out the front windshield and trying to drive around the corner. It's hard to do. So sticking with that same theme, this is a little economic dashboard that we look at. And think of these as the dashboard of your car. When you're driving down the road, do you spend all your time looking at the cluster? No, you glance down every now and then and just make sure things look right, your tire pressure, and you're not overheating, and you're within this, the reasonable speed. And that's kind of how these economic dashboards work as well. Do you spend all your time here? No. But every now and then it's good to glance down and say, hey, how are things looking? Think of it as a zooming out on a macro level and saying, where are we headed? Where's the economy headed? And we'll talk about how that affects the stock movement as well. And I'm going to drill deeper into each of these, but what we're looking at here is Q1 real GDP. Real GDP strips out pricing. So think of it as, we're stripping out inflation here, because we know inflation can inflate the numbers as well. But 2.1% real GDP. That means we had more goods and services go out than this time last year on an annualized level. June unemployment was at 4.2. Generally, 4 to 6% is considered a healthy job market, so it's we're on the low side of that, but low and stable. June payroll, hiring continues, but it's not a super hot job market. What they look at with job market is the net jobs changed month to month. So, some people retire, some people get terminated, some people get hired, but when we add it all together, what was the net effect? Well, we have 57,000 more jobs on the payroll than we did the month before. So that means companies are hiring. Doesn't mean companies are desperate. We're not heating up too fast, but it's continuing. And then one of the inflation indicators is the PCE, which this was as of May. Just shows that inflation is cooling, but it's still not where we want it to be. Long-term goal being 2%, and that one's showing us a little over 4. Last thing I want to mention here is the federal funds rate. This is the cost of borrowing money for banks, and so it has a ripple effect on a lot of other parts of the market. Keep in mind with this, the Federal Reserve, their role is not to drive anything with the stock market. They're not trying to make the market go up or go down necessarily, but it's more of a balancing act of interest rates and the economy and not letting things heat up too fast and drive inflation, but not having things get too cool and cause a recession. So that's how they do that. And I have a slide just on how that works in a second here. But the big picture on the economy, before I break these down a little further, the economy, I would say a fair valuation right now of the economy is that we're not in a crisis, but we're also not in an overheating or an autopilot type mode. It's a healthy economy. And really, from an advisory standpoint at least, that's a good place to be. You don't necessarily want a runaway economy. In fact, one of the questions I asked this morning was, if you would rather have stable inflation, or would you rather have a booming economy? Which one would you rather have? What do you think? Yeah, it's a hard question to answer because everyone wants a booming economy. But what if the booming economy comes with massive inflation? Does it really feel booming for you? Well, it doesn't feel as good anymore, right? But if we have stable inflation and healthy growth, that's a pretty good place to be. So the inflation is stabilizing some, it's coming down. It's still not where it needs to be, but we're at least showing that we're heading in the right direction there. Going a little further on the GDP, like I said, that 2.1% is an annualized number, and that's up significantly from the end of last year, which was a 0.5%. So what this means is, again, it's a good indicator that the economy is working, people are working, we're selling goods and services, businesses are staying busy. I like this little graphic here because this explains how does that translate in the stock market. Like I said, these are economic indicators. They don't tell us exactly what's going to happen, but when you have more consumer spending, our GDP's up, right? More goods and services, business revenues end up being higher, which translates into them reporting better earnings. They said, hey, we sold more than last year, right? Our earnings are up, and then people like that. They're like, oh, they're growing, they're selling more. We want to own that company. And so it reflects into the stock price at that point. That's how, these types of factors get around to affecting the stock price. A good analogy I use here, this is a really important thing to understand here. Because I've talked about, growth is good, and you see increase in prices when earnings are up, but you have to be careful. This statement here is one you have to understand. Growth alone is not enough. In order for the market to respond, they reward growth that's better or worse than what they were already expecting. So in other words, you don't have to just grow, you have to grow beyond the expectation. So if the expectation's already high, you've got to beat that expectation. Let me give you a quick analogy here, and then I'll give you an example, a recent example of how that went. But let's say that this is a classroom, right? And there's one student. Who's my student? Who wants to? Any volunteers? Yeah, Mr. Bird. Let's say that you always get a B. You're just a B student, right? But all of a sudden, there's a test and you get an A+. We are cheering you on. You are the man, right? And so for a company that gets an A+ when they usually get a B, investors are like, I want to buy more. Like, that's the guy, that's the company, right? They're excited about that. You beat expectations. But let's say the expectation is that y'all get an A+, and then you get an A. It's like, yeah, it's good, but it's not an A+. We were kind of expecting you to ace it. That's the same thing with the stock market. So a company could have really good earnings, and then you see the price go down. And it's not because they had good earnings, because they didn't have great earnings, above expectations. Everyone was expecting them to have good earnings, but they didn't have great earnings. And so that's a good, a recent example. Anyone familiar with Micron or MU, the stock? Well, it's been having a heck of a year. It's been, going up, up, up. And recently they had their earnings report, and it was a really good earnings report. It showed profitability and revenue growth and year over year. But the problem is it didn't crush expectations as much as investors wanted to see. So now it's come back like 20% off its high. So even though it was like, you look at the fundamentals of the company, you're like, this is a good company. I mean, they're really, like, the demand is out for a couple of years and profits are rolling in. They didn't beat the expectation, so price went down. And as an investor, that can get frustrating because you're like, I don't get it. Conceptually, this should be good, but why is the market saying it's not good? And this is exactly why here. So very important to understand As far as the jobs piece go, I look at this as everyone knows the story of Goldilocks and the Three Bears. Not too hot, not too cold. You want to get it just right. Well, that's kind of how the jobs report works here. And we've got a little temperature meter here. I mean, too hot, if the jobs report is too hot, in other words, companies are just hiring vigorously and trying to get people in, you end up with wage pressure, and that ultimately translates into inflation. Because all these people are demanding more and more wages, and the cost of goods go up, and then all of a sudden it's like, you're in a scenario where everything costs more. So what's a higher wage really mean? And that's your inflation. But if it's too weak, if companies really, they're like, hey, we're not looking to hire. If anything, we're scaling back. Then you end up in potentially a recessionary risk. So where we want to be is right in the middle there, somewhere, just right, where we're not too hot, we're not too cold, we're the Goldilocks scenario, healthy balance. And that's kind of what we're seeing today. It's not the strongest jobs report we've seen, but it's nice and healthy. And same thing with unemployment. Unemployment's at the low of what a healthy job market would be, 4.2%. So the goal is never to have it be too hot or too cold. Same thing here with job growth. The more jobs you have, the more people you have earning money, the more people you have spending money. And that translates into more spending, which, as we know, goes into more revenue for businesses and so on. Now, if we do it too much too fast, that's where we can start to see inflation. But then ultimately, this is going to end with a Fed decision. Do we raise interest rates? Do we lower interest rates? And so this is just one of those factors it's good to keep kind of a pulse on. How's this looking throughout the year? But right now, I would say it looks pretty healthy. All right. Now, this came out yesterday. This is yesterday's, it was June's report, came out July 14th. And it had headline CPI at 3.5 and core at 2.6. Core is when they strip out the more volatile, like food and energy. And we see that that's at a 2.6. Anytime you have a report like this, the market's going to tell you what it thinks. So yesterday, it was generally encouraging. It was positive stock market, which means people liked to see this. Now, the one thing I would caution a little bit on this June report is what happened in June is we saw the cost of energy go way back down. Oil prices went back down. And since the end of June, we've seen that kind of reverse again. So I'm just not sure how sticky this is going to be, depending on what happens the rest of this month. We might see that this was kind of a temporary momentum that didn't hold. But this was good. I mean, this was a good inflation report to say, hey, we're continuing to cool. Prices are not increasing at the rate that they were. And by the way, with inflation, has everyone noticed how groceries are back to their 5-year low? No, of course not, right? No, of course not. That's never how it works. But when we're talking about inflation, we're talking about how quickly it continues to go up. So we've seen the rate that it continues to go up slow down. We're not going back to 5 years ago prices, I'm sorry. This is not how it ever works. But we want to slow the bleeding, and that's what they're trying to do by bringing inflation down. Like I said, the goal here is the Federal Reserve's long-term target rate is 2%. So making progress towards the goal, not quite there. And last piece on the economy, I believe, is the Fed rate. So I mentioned that the Fed gets to control this rate. It's the cost of money. It's what does it cost banks to borrow money from each other. And they get to set that rate. Now, the analogy I would use because a lot of people are like, I don't understand, where does the Federal Reserve come in and they get to make these decisions and change how everything works? Think of it this way. Really, the decision they make is the cost of money. I mean, that's the decision. So if you think about, let's say you're dropping a rock into a pond, they get to decide how heavy or light that rock is. Heavier rock, you're going to see bigger ripple effects across all of these sectors. If it's a smaller rock, it's going to affect it differently, right? So, when they raise rates, for example, you're going to see yields go up on things like money markets or cash in the bank or CDs or so on, but you're also going to see borrowing costs go up. Now it costs businesses more to borrow money. It costs people buying a house more to buy money to buy a house. It costs them a higher interest rate, and same thing with bonds. The way the bonds work is, let's say you own a bond today, and it was a bond that was paying out 5%, let's say. And all of a sudden they say, hey, we're going to raise interest rates up. Well, your old bond paying the old rate is now worth less than the new ones you can get because now interest rates are higher. So your price of your bond portfolio is going to go down. That's why you saw in 2022, bonds were down like 13%. Because people that own bonds going into that year and then the interest rate spiked, they're like, why would I want your old bonds? Those things are worthless. I want these new ones. And so anytime the Federal Reserve makes a decision on interest rates, it has a ripple effect. It ripples through a lot of different areas of the market. So important to understand what they actually control there. Okay, yeah, one more here. I mentioned this before, very high expectations of earnings now. In fact, if you look at this year, quarter two versus last year of quarter two, the expectation of profitability and earnings for a company is 24% higher. In other words, people are expecting more and more and more out of these companies to squeeze profits and to be, have great earnings reports. So when we have strong earnings reports for a stock, for example, we generally see the stock price go up. People like that, stronger report. But what happens is, let's say a company was up 10% year over year. People are like, great, we love that. Next year we want 15. It's always more. What more can you do for me? And you get to this point, which is where we are with some stocks right now, is, hey, good's not enough anymore. You got to really wow me and crush expectations if you want that stock price to keep going up. So you can end up, like I said, owning a great company and overpaying for it. So you got to be careful, look at valuations, which is something that we're always cognizant of when we're making decisions as well, is are we potentially overpaying for what this stock is worth today? Could be a great company, but you could still overpay. All right, going on to events. So signal or noise. Okay, headlines move markets. Plans should not be built around headlines. We know that. Notice what it doesn't say. It doesn't say headlines don't matter. I mean, I'm not saying ignore the headlines, ignore the news, but what we want to try to avoid is having it derail, what you're doing, what your plan is. So let's take a look. Noise versus direction. And it's important to be able to see something or hear something and make this distinction. Like, hey, is this something that should affect my long-term plan? And generally speaking, you do see some price movement on a headline. A lot of times it's temporary. I'll give you guys a great example at the end of this slide, but a very recent one. But some examples here, oil, the whole thing with the oil prices going up, wars, midterm elections. In fact, even the last election cycle. If you were working with us at that point, you might remember we sent out a couple communications. We had people asking about, hey, elections are coming up. Should I get everything out of the market? Should I put everything in the market? Because it's going to go one way or the other. It's either going to be great or terrible, And our advice to people was basically ignore the noise. I mean, there's going to be noise. You're going to hear, friends going to tell you everything's going to crash, and one's going to tell you everything's going to go to the moon. And, probably neither of those are correct. In fact, the markets are generally bigger than any headline, even in election. And if you look historically, that's proven true. Now, you might see some short-term volatility with some headlines going up and down, but if you zoom out, generally speaking, not going to make or break your plan, a little bit of short-term volatility. So usually you don't want to make big changes to your plan just because of there's an election or a midterm election or some other headline. Where you want to look is more of what's actually going to drive change long-term, the fundamentals. Is a company that you once believed in so much, have they just shown the inability to be profitable anymore? Are they on a decline? Are they going out of favor? Is their cash flow down? You may make a change there because you say, hey, this isn't just a headline. I mean, this company is no longer profitable like it once was. It could be, inflation rates. When rates change dramatically, you might adjust your plan because you weren't expecting the rate environment. A great example of that is in 2020, the rate environment was 0, point nothing. You didn't want anything in fixed income in 2020. And now, a few years later, rates spiked up. You're like, you know what, actually, I'm going to adjust my plan because now I can get a reasonable rate. I couldn't get that a few years ago. So those are the types of things where you may say, hey, this is a game changer for me, not necessarily a short-term blip. that I want to change everything. So looking at the fundamentals, very important to do there. Oh, quick example. Anyone ever heard of Lucid Motors? Yeah. Anyone see what happened yesterday? No. Okay, so I don't drive a Lucid or anything. They're an EV manufacturer, electric car. They're really cool looking automobiles. But I've kind of like followed them here and there just because I think they're cool. But they've been on a decline. I mean, the stock really hasn't done that well. The company is, I think they make a really great product, but they just haven't figured out the business side of it, the economics. But they're interesting to watch, you know. Well, anyways, yesterday, all of a sudden, midday yesterday, Lucid stock dropped 50%. 50% in like an hour. It dropped 50%. It was already down significantly, dropped 50% midday yesterday. And then what happened is about an hour later, their corporate communications director came out and said, hey, what you guys saw on those headlines was completely false. Someone had gone and made a post about them considering going into bankruptcy, and all the news outlets picked it up like it was real. And it wasn't real, and he came out and said, well, our cash flows are good through the end of next year, and the whole thing. But the point was, it was fake news. It wasn't even accurate. Somebody was manipulating that stock, and headlines ran with it. I did not. No, actually, I didn't see a lot of this till later in the day because I was a little tied up. But it's an interesting story. We're talking about how, don't always make a change because of the headlines, you know. So a lot of people sold out of that stock thinking, they're going to bankruptcy, get me out. And they sold all the way down to a 50% loss. And then they came out and said, well, that's not even true. That's not even real. Now, I'm not saying buy Lucid or don't buy Lucid, but I'm just saying that these things happen. You know, you can't always just knee-jerk react and expect that something is, because fundamentally, did anything change between their business from yesterday morning and the end of the day?
Did they regain?
Regained most of it.
Okay.
I think they regained, they ended up with about a 15% loss on the day rather than 50. So a lot of it did come back, but fundamentally nothing changed about the company from morning to evening. You know, it was all the noise in between. So anyways, this is one example of that. Here's another example of how a headline can ripple through. This is more economical, but you have a geopolitical event. You know, we went and bombed Iran, and they closed off the strait, and we know the oil prices went up. Well, what happens when that oil prices go up is it creates that inflationary pressure because oil dictates pricing on a lot of things. In fact, transportation, and then it moves into your goods, and now all of a sudden things cost more money. And so this is the kind of thing where the feds, they can't ignore that. They say, hey, the cost of energy is up, the cost of goods are up, inflation is therefore up. Is this the time to cut rates? Maybe not. In fact, maybe we need to look at raising rates again to battle this inflation, which we were told, hey, expect rates to come down for the couple of years, and we've been kind of in a stalemate. Really hasn't been movement in either direction for quite some time on rates. Now there's a new Fed chair in, not that really changes anything, we'll see, but his first meeting was hold. So we'll see what the next one looks like. But we're at a situation now where we might actually see rate increases at some point, which is hard to believe because we all thought for sure rates are coming down. But again, the goal is not to predict world events, but it's just to understand whether something like that changes your plan philosophically. Do you go make adjustments to your plan based on it, or do you say, hey, this is short-term noise, I probably don't need to go change everything? I wanted to put this in here on AI. How am I doing on time? Yeah, I think I'm okay. I want to put this in on AI too. Like I said, AI's been a hot topic for a lot of people. There's been massive amounts of investments in chips and data centers and storage, memory, all of these things that they're being told, we're going to need all this. We're going to need all this for AI to do what it needs to do for these businesses. And it's still, I would say there are some companies that are more on the speculative side of AI, where you're taking a bit of a gamble with these companies. And one example would be like these data centers. In fact, I think they're actually doing a data center here in Charlotte County. I don't know if anyone heard about that. Big data center. So data centers, what they're saying is we're going to need these massive data centers to house all this data for AI to do what it needs to do. And so there are some companies that their entire business is these data centers. And why that can be a little speculative is this all may come to be true. And we need these data centers, and there's no way around it, and the companies do very well for a period of time until we stabilize. There are also, there's been a couple of headlines that say, hey, we might not need all these data centers because we can get more efficient with what we're doing, and there's other ways to accomplish it. And think about it, if the one company, if their only business is the data centers and there's a way around the data centers, you got a lot of risk in that one company. Now, there are other companies that have a lot to benefit from AI as well. Think of your Googles, your Microsoft, your Apple, and all these big companies. Now, they could actually do very well with AI as well, but is their whole business dependent on AI making or breaking? No. It could really help them accelerate things and become more efficient and have new innovative products and so on. But they are already so saturated in the markets with products and services and servers and all these things that maybe there's less risk. So if you're thinking of, geez, how do I want to be invested in AI? There's a couple ways to go about it. You could invest in the more behemoth companies that have something to benefit from AI, or you could be a little more speculative and go directly to the company that their one thing is AI focused. It could be, like I said, memory or storage. I'm not saying either one is right or wrong, but it's important to look at things like valuation. If a company, let's say, is not profitable, which this is happening a lot these days, company's not profitable, but man, they could be someday. And you got all these people buying into this company. Well, sometimes that comes true. Sometimes they do become profitable and they get there and there's all this back demand, but sometimes that doesn't ever come true, and you just end up kind of sitting there losing value, losing value, losing value. So, I would say if you're going to be speculative with your portfolio, just to keep those things in mind. What are you actually buying? Are you buying the idea that something could become great, or are you buying something great today that could become greater? And I think those are important questions to ask when you're looking at these types of investments. I did do a little comparison because I get this question every now and then is, hey, are we in another bubble? Is this thing going to pop and we're going to see another like a .com? And one, I can't say yes or no to that question. I mean, again, we can't predict the future, but there are some similarities for sure on what's happening right now with AI compared to what happened with, really the internet boom of the late 1990s into 2000, where, back at the dot-com boom, you had all these high expectations. You didn't have a lot of profit really, but you had a lot of like, this is gonna be big. This is going to be the next thing. And by the way, a lot of that was true, but investors got a little bit ahead of themselves before these companies were actually very profitable, and it all fell flat after 2000. Things, basically the bubble popped and everything reset valuations, and it took several years to get back to where you would have been. Now, right around the time you got back from the dot-com bubble is when we had the financial crisis. So it was a tough decade, 2000 to 2010. But in a lot of those cases, there was more speculation based. Now, like I said, did that come true? Did the internet change the way things are done? Of course it did, But for the investors, a lot of them lost a lot of money in that time period, 2000 and so on. Today, you see similar demand, similar hype to what happened back in the late 90s. A lot of these, and again, you got to look at each company, but a lot of these companies are already very profitable. So that's one of the differences. You have a lot of revenue and profit, not just speculation, but some of it is still speculation based. Businesses are investing heavily in each other as well. You got a lot of these major contracts between, multiple companies that are all kind of trying to do the same thing. So they're almost propping each other up, which maybe is a good thing, but there's also risk there for sure. So I'm not saying it is or isn't, but I would always go back to valuation, just knowing what you're buying and having that be kind of the guiding light on what you're doing there. Okay, I almost didn't put this slide in because I'm like, listen, I do not want to be polarizing here. Yeah. But the reason I put this in is every time there's a new IPO, we get people contacting us. And they're saying, hey, I don't care what it costs, you get me in that IPO. I want in. I'm not even worried about the price. I just know it's going to be amazing. I had people do that with Newsmax. I had people do that with the Donald Trump stock company, Trump Holdings, whatever, yeah. And then this most recent IPO just happens to be SpaceX. Now, this is not me beating up SpaceX saying it's good, bad, anything. It's any of these IPOs, right? Generally speaking, we're not going to encourage clients to jump into the early hype of an IPO. And this is just one example, but you know, this was a little over a month ago, launched at 135. And then by the time it actually opened trading, it was 150. So it already had jumped up about 11%. And then really in a short period, it was like a week, it went to 225. That was like an intraday. It was a little higher than 225. This actually, as of this morning, it was 136. So I don't know if anyone, is it 136 right now? Yeah. So anyways, this morning it was 136. I don't know if anyone has quick access to that. But anyways, the point being is we're already back to the IPO price. Now, a lot of people bought this in the 200s. Yeah, a lot of people bought it at 200, and they said, hey, and a lot of that is FOMO. It's like, hey, I see this thing going up. I know it's the future. We're going to Mars, I got to buy it at any cost. I'm going to buy it at 200. And if you bought it up there, you're already down 35, 40%. Now, am I saying it's not going to get back there? So, I don't know. Maybe it will, and maybe it won't. But the point is, with an IPO, it doesn't always make sense to jump on the early hype of an IPO, because we saw this happen. Newsmax was another one. I don't know if anyone's familiar with Newsmax, but I had people calling me. I mean, Newsmax was just running. It was like $40, $50, $60 a share. And now, if you bought Newsmax, you're down like 95% of where it was. So it's not to say they're good or bad companies, but there's so much excitement, there's so much hype built on some of these IPOs that if you get in early, a lot of times you get hurt. And maybe, listen, we might actually even start buying some SpaceX now. I don't know. But the point is, maybe you don't have to be that pioneer that takes the early hit, in these. Looking at, and by the way, here's the biggest thing I want to share about this. And again, this is not really about SpaceX, but let me ask you this. From June 11th to today, did anything about SpaceX change, the company, the fundamentals? It's the same exact company it was a month ago. But look at all the noise that happened in between, right? So sometimes the company and the price are two different things. You got to look at both. You got to look at the company, and you got to look at the price you're paying for the company. 134. Okay, we're now down below the IPO pricing. So, and again, this is not to shame any one company, and I actually think SpaceX is really cool, but I'm not saying buy it or don't buy it. It's just know how these IPOs work, and we've just seen the same thread over and over, so I think it's important for us to touch on. All right, section 4, risk management refresh. So I'm going to go quickly through this one because we are getting a little short on time. But a lot of times when we talk about risk management and a stock portfolio, if I went on the street and said, hey, what's your biggest concern with your retirement portfolio? They'd say a market crash. A market crash would be terrible. And I agree, and that's definitely one thing. But a lot of times they just think, people think that's the risk. A market crash is the risk. Well, let's just say the market never crashes for the next 20 years, and that could happen. Maybe there's going to be pullbacks and things. But let's say there's never a crash, but yet inflation was, 4 to 5% for 20 years, and taxes increased over time, and you had a healthcare event, and all these other things happen. But you were so focused on, man, there could be a crash, though, that you ignored all the other risks. So the point of this is really to say, yes, we've got to look at the risk you take in the market with your portfolio, but don't let that deter from other risks that exist. Our role is to try to help you balance what's the right balance of mitigating all of these risks, or at least the ones that are most likely to affect you, whether it's inflation, taxes, and so on. This is a part of it. So I just want to touch on risk number here. Does anyone familiar with this? Have you seen a risk number before, like a 1 to 100? We use this in the office as well. But what I want to just emphasize here is it's important to know your risk number, and there's no right or wrong answer. You could think of a driver. Some drivers are happy to be going 70, and others are going 50 or 40, and neither one's right or wrong. Now, if you're going 20, you're wrong. No, I'm just kidding. But no, everyone has a different tolerance, right? And that's okay. So this isn't a quiz, like the higher score is better. It's just what's your score? And then the second piece of this is if you know your comfort level, or if you're more moderate, if you're more conservative, more aggressive, the next question becomes, is what you're doing lining up to your comfort level? And sometimes yes, sometimes no, but you should know that.
Is some of this age figured by your age too, as you get older?
Not necessarily, but if you look at in practice, a lot of times as people get into retirement, they generally become a little more conservative. And that's just, I think, human nature. You're not working anymore. You're not out there, making wages. Yeah, it's a little more, and that's not for everybody. I mean, it's still a personal decision, but some people are like, they take things like preservation and income a little more, they weight that a little more than growth. Because they say, hey, I'm at a point where I've built this up. Now I don't want to just put it all out there to risk. I want to live off this thing.
Yeah, there's no redo sometimes.
Yeah, exactly. Yeah. So, and by the way, I'm glad you mentioned that because one of the reasons we're bringing this up is the stock market's been relatively cooperative for quite some time, really. So would it be a good time to check in on your risk, you think, when things are going on pretty well, or after something really bad happens? Right now is a good time. Let's say that the market's dropped 25% and you're like, you know what, I got to look at that risk. I got to probably reallocate some things. Well, you just took it on the nose. So maybe not the best time to go change things. So this is a great time. I think it's a great time for really anybody just to take a second look at how they're investing and not to necessarily even change anything, but just make sure it's still what you're comfortable with moving into the next 6 months. This is what I talked about. You're going to have all these different risks that pull your plan in different directions. It could be taxes, it could be, longevity or interest rates or, the stock market or sequence risk, taking income early in retirement. There's a lot of things out there, so your plan needs to be able to address all these. And by the way, you can't get all these risks to zero. That's impossible. It's just what's the right balance of tackling these risks. And sometimes people think, well, yeah, easy. I'm going to get out of the market and put everything in just conservative cash, and then I know I won't lose. But yeah, but now look, now you've got all these other issues, taxes, inflation, purchasing power, longevity. Your money's going to run out too soon. So there's no right solution to just mitigate everything. But what's the right balance for you of mitigating as much as you reasonably can? All right. Same thing here, really. I'm not going to go into this one much because I think I'm basically out of time. But, there's all these risks, market, income, inflation. Notice this one on the bottom, behavior. To me, this is maybe the top risk. And if you look at over time, would you say more people, do you think the stock market has ruined more people's retirements, or poor decision making has ruined more? I think it's poor decision making. I mean, yeah, the stock market can hurt sometimes, but I think the bigger factor is the decision making. It's the people that lost 30% and were like, get me out. And then what happens right after that? Of course, it came back and they lost it, and now they're going back to work. So a lot of times it's decision making. Now, your decision making affects almost all of these things. Do we have direct control over some of the big picture things like tax rates or markets? No. But we do control our plan and our portfolio design and the risk we're taking and so on. So behavior is a big one. And one of the toughest things about behavior, I'm going to skip cash for now because we all know cash. One of the biggest things with behavior is this right here. We got this constant tug of war going on between fear or anxiety and euphoria or greed, right? And these are traps for people's plan. Your plan lives in the middle here. And so people that become fearful and they're worried about their plan, they're worried about the market, they might say, hey, I gotta sell, I gotta get out, I gotta move to cash. And whenever that happens, it's usually to someone's detriment. I'm not saying it's impossible. I mean, if you're a day trader and you're timing the market and you get it right, you could benefit. But for most people, being fearful, selling things, maybe at an inopportune time and not knowing when to re-enter the market, those things hurt. Same thing with euphoria. We see a lot of this. People chasing something that's hot. They're like, hey, my buddy's up 50% of that. I need to get that. I want in on that train. And then, of course, what happens the minute you buy it? Of course, right? So these are always going to be factors. This is the emotional part of investing. It's greed and fear. It's the same thing that moves the stock market a lot of times. People become fearful about the economy or what's going on with a headline. People become greedy about what's possible or where we're headed. So it's important to try to ignore some of that noise and always go back to your plan. Your plan. Your plan might be boring sometimes. But that's okay, but it's your plan on how you're going to get there long term. We're not looking at making short-term tweaks all the time. We're looking at our long-term plan. So a couple quick things to review. Big one right now, I think, again, in the middle of the year, it's rebalancing. It's, maybe when you started your plan, you had a certain amount that was dedicated to the stock portion of your portfolio, and then a certain percentage that was on conservative assets. It could have been cash or notes, bonds, annuities, anything, but something that really wasn't going to take a lot of risk. And what happens is over time, you're going to organically drift away from that, especially if the stock market's been up, because the stock market ends up being a bigger and bigger percentage of your portfolio because it grew more than the conservative assets. So this is a great time to go back and say, hey, have I benefited from growth in the stock market? Is it time to maybe rebalance some of this while things are good and maybe restore back to your intended exposure? A good analogy I would use here is, if things have gone well, do you take a few chips off the table and get back to where you started? Kind of know that you get to keep those chips because you took some off the table, but you still have your main investments out there that you intended to in the first place. Good time to look at those things, and especially if it hasn't been looked at in a time. Some of the great reasons to rebalance, like I said, portfolio drifts. You're doing a calendar review, maybe a 6-month or an annual review. Some of your needs have changed. Like I said, maybe you're retired now and you're like, I'm a little more worried about income than I am about chasing, massive returns all the time. So maybe I'm going to shift a little bit more of my portfolio into something that's more dependable, that I know I can, generate income from. Or maybe your risk tolerance has changed. I'm just not as aggressive as I used to be. Maybe I'm a little more moderate now. Those are all great reasons to consider rebalancing your portfolio. Poor triggers, again, if you're going to change the way you invest because of a headline or because you got that advice from a friend that they worked out for them, so maybe I should do it too. Or this is a big one here, fear of missing out. You just get that FOMO, like, I should be in all of that. And you make a big move, and it's not always good for your long-term plan. So good time to rebalance is because your plan needs to be adjusted, not because your mood changed, not because emotion creeped in and you either got fearful or you got greedy. Those aren't good reasons to change your plan. So something to think about. Not going to get too much into this one, but every asset you own should have a role. You should know what the role is. Is it preservation? Is it income? Is it growth? And by the way, you don't want any or every asset doing all of these jobs. If you had one, asset that was trying to do all of this, it's probably going to do a pretty terrible job of preserving, growing, generating income, and so on. So it's what's the right balance for you, but ensuring that every asset is serving its purpose. Is it there for your short-term emergency funds and you're trying to, have some yield on it? Is it really there to bridge the gap and give you reliable income? Is it there for your long-term growth? So you should be able to look at your portfolio and kind of know, why do I have that part of my portfolio? What purpose is it serving? And this is, again, mid-year. It's a good time to look at these things. All right, I'm going to skip to a little mid-year checklist, just something to think about here. And I can send this out if it's helpful, but just some questions to ask. Has your risk level drifted higher or lower than you intended? It's a good time to look at what's your comfort level, and is that what you're doing today? Like I said, we have software too that can help us understand that. If you want help with that, we can look at it. Do you have enough safe money for your near-term withdrawals? We know that any 6-month period could go up, could go down. So what's your short-term income plan? Is it going to be reliant on the market always being up, or do you have a plan for that? Holding too much cash out of fear. See that all the time right now. See it all the time. People have all this cash, and they're like, I just can't invest now because the market's been pretty good, so I'm going to wait for a crash. And the crash just never comes, you know? So you might be holding more cash than you mean to. The other thing is, a lot of times when you hold more cash, that interest you're earning is also taxable. So add that on to your tax bill at the end of the year. And are you really earning 3.5% or is it 2.5%? By the time you pay your tax on it. Is your portfolio too concentrated? There was a slide here, I had to skip it for time, but I had a guy come in recently that's like, I am very diversified. I have 90 holdings. And I said, wow, that's impressive. And so I looked at his holdings, and there was a whole lot of same holding, different wrapper. I mean, he's like, I've got the Invesco S&P 500 fund, I've got the Morningstar 500, the Vanguard 500, and I've got the iShares 500. And I'm like, well, those are all the same thing, just a different name. So diversified, when we're talking about diversified, doesn't mean just own the same thing over and over in the same types of funds. It's, own some different sectors, parts of the market, own something that's, maybe not correlated with your high growth stocks. So it's not an all or nothing proposition for you. But how diversified are you? Do you understand how inflation affects your income? Do you have a plan for volatility? By the way, a good time to have a plan for volatility is not after it happens. It's before. So this is the time to say, hey, do we have a plan in place if we have some short-term volatility? Is there an asset that we've set aside that could float us through, let's say we had a rough year? And if the answer is no, you might want to look at it. I mean, it's a good time to be reviewing your portfolio. Am I making decisions from a plan or from headlines? And I would say that question should always be in your mind. If you're thinking about making a significant change to your methodology of how you're investing, ask that question first. Am I doing this because I read something or heard something? Or am I doing this because it really is best for my long-term plan? All right, guys. Whew, we did it. I know that's a lot of talking. Second half, you don't have to predict it. You just have to be prepared for it. It might be great. It might not be great. But is your portfolio and your retirement plan, is it going to hold up in either scenario? And that's really the question to ask yourself. Next month, we have long-term care planning. So that one's a little more niche, but it's really about, if your two options are to go on Medicaid or to fund your long-term care yourself, what exists in the middle there that might be attractive to you? And we'll be going over that next month of just some options and how some people handle that. But otherwise, thank you guys for being here and taking your time. And I know a lot of you drove, and so really appreciate it. And we'll hang out for a bit. If you have individual questions, I'll be here. Or, like I said, ask Scott. So, all right, thanks, guys. Appreciate you coming. Thank you.